All right, in this video, we are going to talk about the two restrictions that just about every money manager has of people that are watching this video. And these two restrictions are by prospectus. They can't do anything about it. And when you look at a trend, because that's what a money manager really needs, right? They need a trend. They need something to grab onto. So in the up markets, which is generally what markets do, these restrictions do not affect you. They're actually work in your favor. Sometimes market goes sideways. We'll talk about that. But this is the one everybody is worried about, right? This is the 2008. And as we exit 2015 and we're in 2016, this is what is on everyone's mind. And so these two restrictions absolutely kill you in the 2008s. And those restrictions are, number one, the manager must stick to the asset class of choice in their prospectus. So I've done other videos. One video, if you want to watch Modern Portfolio Theory video, it goes in, it'll explain to you about the asset class. So the point is that if you are a money manager and your prospectus says that you can be a large cap growth manager, so the Morningstar style box, right? You have large companies, medium-sized companies, small companies. You have value, blend, growth. If you are a large cap growth manager, in today's vernacular, that means you can only buy Apple and Amgen. If you wanted to invest in something else, you wanted to buy U.S. Treasuries, guess what? You can't do it. It's a single asset class. That's what you have to operate. You have to stay in this box. The second restriction, which is really the real killer, is that a money manager must stay fully invested. By prospectus, depending on the language, 80 to 90% of the funds must be invested in the particular asset class. So when a manager gets scared, when they know, and folks, everybody knew what was going on in 2008, just like we have the same anxiety here going into 2016, we all know the case. But if you have to be fully invested and you're a large cap growth manager, what do? Well, that's my version of a chair. I could make it three-dimensional, I guess I could. You just hold on to the bottom of your chair and you just go down. And so, the S&P went down 37%. That's just the S&P in 2008. Most managers were 10 to 20% greater loss than this. You know it's coming, but because you can't do anything about it, you just go down with the ship. So the key is to have a platform that is different than that. And I have to be careful on a video like this. I don't want this to be a solicitation. If you want more information, you can contact us, talk to one of our registered investment advisors, and we can walk you through how we do this specifically. But I'm just going to keep this in general. Our platform, you can only get on our platform if you meet two criteria. Number one, you had to manage money successfully through 2008. And number two, you have to be able to hedge in some capacity. So our managers can hedge one of three ways. Some of them manage all three. Some of them only use one. So let's go through what these hedges are. First, go to cash. Meaning if you're a manager and you are scared about what's going on, you think this is coming, you just simply go to cash and then you reinvest when things have bottomed out. Because remember, we're trying to do what? You're trying to buy low and you're trying to sell high. Well, unfortunately, when 2008's come along, people do the exact opposite. There's a cratering, the market goes down. They've already bought up here, they get scared, and they sell down here. So they actually bought high and sell low. So hedge, go to cash. Secondly, is use an alternate asset class. Meaning, if you're a stock manager, you're on our platform as a stock manager, but in 2008, just so you know, the number one performing asset class the first 6 months after 2008 was what? It was U.S. Treasuries. Why? Well, flight to safety, right? Everybody gets scared. Money goes into something, price goes up. So using an alternate asset class, even if you're in this box, you have the ability to do that. And number three, and this is the big one, is you can go inverse. Meaning use a financial instrument that as the market is going down, your instrument is going up. So we did a video. It's called Inverse ETFs. So if you want education on that, I kind of walk through how that works, because this is a new phenomenon. You know, we've had this since the 2000s, but really it became very popular since 2008. So you can get an education by watching that. But the reason I want to do this video is, as we are, I'm doing this video, it's January 2016, right? So, going into 2016, everybody's nervous. I'm telling you, the managers you have these two restrictions. You do. And, we can do an analysis. You can contact us. We'll do an analysis for you. If what you have is good, it'll be obvious. But if you don't have what is good, wouldn't you want to know why? And our analysis can help you with that. And then we can explain how the platform works. But mainly I wanted to introduce you to this, because you're not going to hear this from your typical financial advisor, because they are doing the buy and hold strategy, pat you on the head, say it's all going to work out in the long run. Well, that's true, because markets do generally go up, but boy, when they go down, they really hurt. Okay? All right. As always, subscribe to the videos. You can go to Brinkman Academy and see these other videos, and you want to reach out to us for some insights, some analysis, you can certainly do that as well. Thanks for watching.